Hello there, everybody. So this is a bit of an unusual video, which I haven't talked about this subject in a while, but I've mentioned before that my degree is in finance. I have a bachelor's degree in that, and over the years, I've been like observing how people talk about things like both personal finance, corporate finance, the economy as a whole, and I've realized that there's a lot of things that people just don't seem to understand that well, or they just know very little about, or they've been misled on, or something. And I don't think that's a good thing. I think this is important stuff to know about because there are people in like government or business who know that regular people don't know a lot about this and they use our ignorance to their advantage. So this is just going to be like a pretty basic look at some basic financial stuff because believe me, this shit gets remarkably complicated. Like there's a lot of stuff when you really get into the weeds that even I don't understand. But this is just going to be some basic stuff that we're talking about so that you can understand a little bit about it. And this isn't going to really be like me saying, here's how you can get rich quick. Definitely not that. And it's also not me saying, like, here's how you can make sure to save properly for retirement. But there might be a little bit of that in here, but this is more just to like keep yourself safe and how to help save money and maybe make a little bit. So we're going to start with what is the boogeyman of many libertarians and many people who are not libertarians, the Federal Reserve. And believe me, you could teach an entire course on this. I basically took one in my final semester of college. But basically, the Federal Reserve in the United States, because our currency isn't based on anything like gold or anything, our currency is just based on how much faith people have in it. And so the Federal Reserve is in charge of that. It's in charge of a couple other things as well, but mainly it prints money, and the way it decides when to print money is by having a an interest rate. So basically, when banks don't have enough money, they'll take out a loan from the Federal Reserve, and the Federal Reserve will just create that out of thin air, and then they'll just give it out to the banks. And if it's a very low interest rate, then more banks will be using it, and it just pumps more money into the economy, basically. Higher interest rate, it slows the economy down. And over the past like year and a half, we've been having much higher interest rates because we've been having difficulties with inflation. So slowing things down is better, and it does seem to be working a little bit. Now that is the short version. And I'll be the first to admit the Federal Reserve isn't perfect, but if you actually look at how the economy worked before the gold standard, or excuse me, back when there was a gold standard and stuff, there were constant boom and bust cycles where we would have like really good periods of growth and high employment and stuff, and then it would all crash all at once, and we'd have a really bad recession that would last a really long time. Like modern recessions are both less severe and less long lasting than they used to be. And people say, well, our currency is worthless because it's not based on gold. Well, gold only has value because we decide it has value too. You know what I'm saying? And there is a limited amount of that. Whereas with money, or fiat currency, I should say, you can just make as much as you need. Next up, I'm going to talk a little bit about mutual funds. Now, you're probably familiar with stocks. You know, the stock market, even if you know next to nothing about it, you understand the general idea. Like a stock is a little certificate basically saying you own a small part of this company, and in exchange, you either get paid dividends, sometimes they don't pay dividends, sometimes they do, and you also can vote in who gets to be like in charge of the company. And I say in charge, but really the CEO and them are just managers. And mutual funds are funds where a whole bunch of people, like regular people usually, but sometimes institutions like banks and stuff, will give their money to to managers, basically. The managers take all this pooled money and it becomes part of the fund. And then they will go out and invest it in not just stocks, but other stuff as well. And then when that generates money, like when you get more money back than you put in, then you can withdraw it from the fund, and the investors have a little bit more money, but the management takes a small percentage of that for themselves. And a similar thing to mutual funds, which you've probably heard of mentioned in movies and stuff, is a hedge fund. Now, a hedge fund is very different because number one, it's not something that normal people can invest in at all. Like this isn't something where like, okay, I have $100,000 in retirement, let's go to a hedge fund. No, this is like if you have millions or billions of dollars of net worth, you put it into a hedge fund. Now, this, like a mutual fund, it is actively managed. So you have a guy up there saying, okay, here's some good stocks, here's some good stocks, here's bad ones. And ideally, it will, slowly grow. However, hedge funds are different because they're not really meant to maximize growth, although you might think that when you hear that like only the richest of the rich are using these things. In fact, they actually will have lower growth than the market as a whole overall. Their goal is to minimize volatility. Now, volatility is a bit different than risk. Risk is like, okay, you buy something, and then when you sell it off, you have less money or no money. So it's like, what's the odds that you lose money? Whereas volatility is basically how much the value of something goes up and down. Like, again, you don't have to be an expert in the stock market to know that stocks from certain companies go up and down a lot, whereas others are more stable. And sometimes stability means it just kind of trades sideways, doesn't go up and down that much, which isn't good. And other times, volatility means that sure, it goes up and down a little, but overall, it is on an upward trajectory. And hedge funds want to minimize volatility because like if I were to talk about say stuff that I have in my retirement account, then volatility doesn't matter that much because I'm not going to be using that money for another 40 years at least. Whereas people who have a huge amount of their net worth in the market, which is most wealthy people, they might need to withdraw some of that money right away. And if they get it at a bad time, then that means, oh, okay, I'm going to have to be forced to sell some of these off at a loss. So I just lost money at that. Like Tesla, for instance, is a company that is constantly going up and down, up and down. And a hedge fund uses a wide range of strategies, which is very vague and broad, I know. But basically, the idea is to minimize volatility. Like minimizing volatility, again, usually means that the rate of return is a bit lower, so your money will grow a little bit better or faster if you just put it into the market. But also, you don't really have to worry about losing it if you suddenly need to withdraw some. The term hedge fund comes from hedging your bets. So, like one of the most common strategies that they'll use is that they'll buy stocks and then they'll also short that same stock. So that way, if it goes up, then they make money. But if it goes down, then they'll still make some money from shorting it. But whether it goes up or down, they'll not make as much money as they would have if they had just gone all in on one or the other. And then there are ETFs, and ETF is exchange traded fund. These are kind of like mutual funds, except they are all automated. Like we one of the most common ones is SPY, which is just following the S&P 500, which is the 500 most valuable companies on the New York Stock Exchange, and that one is just okay. You buy one share of SPY, then that means whatever the price of that share is. I believe it's like a little over $400 right now. It takes that and divides it between the 500 companies there, and the ETF will buy a proportional amount of all of those stocks. So if the market goes up 3%, then the value of SPY goes up 3%. If it goes down 3%, it goes down 3%. And these are traded on the market just like with stocks. So, they can be volatile. And some of them have much more complicated strategies than that, but that again, they're all automated. It's the same strategy all the time. It's not like a mutual fund where it is just a guy who manages it saying, okay, I think this is good, I think this is good, I think this is bad. And generally speaking, ETFs have a better return. Not always, but generally speaking. And because they're automated and they require a lot less work to keep them running, they also have they take a much smaller portion of your earnings for themselves. Like mutual funds are usually like 2%, 2.5%, which means that you have to beat the market by more than 2.5% in order to make more money than you otherwise would have if you just put it into the SPY ETF. Because ETFs are like 1/3 of 1% cost. Like it's insane. Like it's a massive, massive difference. And as a brief aside, before we move on to the next thing, I just want to mention that a lot of people think buying stock means you're giving the company money. Usually not. Like, sure, sometimes the company will own some of its own stock and it will sell it off for one reason or another, or it will do uh, an equity offering where they just make a bunch more stock and put it out there for people to buy so that they can raise money for something. But most of the time, you're just buying it on the open market, meaning somebody else is trying to sell it and you're just buying it from them. So, again, just a small thing, didn't really warrant its own section or anything, but I just felt the need to bring that up. And after that, just want to take a brief moment to talk about IRAs and 401ks. And I don't know exactly how this works in other countries, by the way. This is just an American thing. But a 401k is kind of like a pension, right? Where like a pension is something that your company, or if you work for the government, then the government will just, as you work there, they'll put money into like its own pot, I guess. And then once you retire, you can take that pot and withdraw from it. Usually they withdraw like once a month or something, and that's just what you live off of after you've retired. And a 401k is kind of similar, except usually it's you taking a portion of your own earnings and putting it in there. And sometimes the company will match it, sometimes they won't. Like pensions are better, but like good luck finding a pension job in this day and age. And then IRA is individual retirement account, and these are ones that like you run by yourself. Like you can get them through a whole bunch of different companies. Like there is Vanguard, Charles Schwab, T. Rowe Price, like all those types of things. And that is basically the same idea. So you can see this chart here. Like this green is the money that somebody is hypothetically putting in. Like you put in, say, $100 a month or something, and then the amount of money you earn on it is obviously based on what you invested in, because this money is going into the market usually. Like what specific part of the market depends. Like you can put it into specific stocks, or you can just let it sit in a money market fund, which we'll talk about later, and let it slowly grow interest. But ideally, it'll grow a lot. And you can see it by year 20, it's like double what it would have been if she had just, stuffed money into the mattress. There's two basic types of IRAs and two basic types of 401ks as well. There's traditional and there's Roth. Now, traditional means that whatever income you put into the IRA or 401k, you don't pay taxes on that right now. So, like, you have a bit of extra money right now. However, when you start withdrawing from it, like 30, 40 years down the line, you will have to pay taxes on the money that you withdraw. And a Roth account is the exact opposite, where whatever money you put in there, you still have to pay taxes on that right now, because like the government's going to get their cut no matter what. But when you withdraw from it decades later or years later, then it's tax free. So it's basically saying, do you want to pay now or do you want to pay later? And for most people, it's better to have a Roth so that you can just get it out of the way now. But sometimes a traditional would be better. Like you should do a lot of research into that yourself if you're looking to set this up. And I am not the person to ask about that. But that is the basic gist of it. Like this, it's not that complicated, but also a lot of people just don't get anyone telling them about it. Next, just a little bit of a talk about bonds. Now, bonds are essentially a loan. Like if you buy a $1,000 bond, either from the government or from a specific company or wherever else, then that is you saying, okay, here's $1,000, and then they will pay you back with a bit of interest. And the interest rate varies quite a bit, as we'll discuss in just a moment. But that is the gist of it. So if it's like a 10-year bond with a 5% interest rate, then that means every year you get 5% of $1,000, which was the original. So $50. Yeah, every year you get $50. And usually these interest payments come every 6 months, but it varies. And again, bonds do have some risk, because if the company goes under, then like the company will be liquidated, and they will use that money to pay back its debtors first. So like the people with bonds, you are a debtor, so you're you're front of the line to get paid back. But if there's not enough money, then you just lost it. So it's low risk. The only place where you can truly get zero risk if you're investing in bonds, or just hell in general, is the U.S. government. Because the US government does have a lot of bonds. Like when people say the US government is in massive debt, like, yeah, they're not just going to China and begging them for a loan or anything. They're just putting out these. Okay, a new ad keeps popping up down here. It's really annoying. They're like literally giving out these slips of paper, and people are buying them. Sometimes companies buy them, sometimes foreign governments buy them. Sometimes, hell, like the Federal Reserve itself, which is not part of the government, actually owns a bunch of government debt. And sometimes, private individuals buy them. Like I own government bonds. Like I would show them off to you. In fact, I would like to show off a bunch of this using like my own retirement account, so you can see specifically how it works. But I don't want to give that information away on the internet. Sorry. But like, yeah, when people say the U.S. government's in debt, like I'm one of the people that it's in debt to. Now, generally speaking, you can see this is the yield curve, which means that, and this is actually the yield curve for August 18th of 2015. I'll show you the modern one in a minute. But basically, the US government has never, ever, ever, ever defaulted on its loans or its loan payments. Like with 100% accuracy, or is accuracy the word? I don't know. But 100% of the time, it has paid the money it owes on time every time. So like it is not low risk to get government bonds. It is zero risk. Zero. Full stop. End of story. And that's generally considered the only thing that's zero risk in the world of finance, but there are some other stuff which can get pretty close. But anyways, we look at the yield curve and you see if you buy a 1 month bond, so a bond that matures in 1 month, then the interest rate there is 1/20th of 1%, so 0.05%. That's not a whole lot. But you can see as you go over longer periods of time, like 6 months, that's 1/4%. 5 years is 1.6%. 30 years is 2.87%. And these are actually very, very low interest rates, by the way. Like for the past 15 years, we've had tiny ones. Like ever since the market collapsed back in 2008, and they're just trying to get the economy running, like I was saying earlier, the Federal Reserve lowers interest rates by a lot, and that affects everything. And the reason that interest rates for bonds that take a longer time to mature is higher is because, well, number one, the farther in the future it is, the bigger chance there is that something might happen and something bad might happen. You might not get your money back. Now, granted, if we're talking U.S. Treasuries, then if the U.S. government stops paying back its debts, then we probably have bigger problems than just losing 3% on a bond, to be honest. But that's actually why it's such a big deal when Congress is refusing to raise the debt ceiling and they have a whole fight about it. Because if they truly default on it, then that's going to throw the entire world financial system into a tizzy. Generally speaking, the yield curve does look like this. However, if we go to today, which is 2023, August 18th, or actually it's August 20th right now, but August 18th was Friday. That's the last day the markets were open. But you can see right now it's an inverse curve, meaning that 1 month interest rate is 5.53% and a 30-year is 4.38%. It's actually lower. And an inverse yield curve, some people say that means that there's going to be a recession soon. It doesn't mean there's going to be a recession soon. It means that the bond market expects there to be a recession soon, which would mean that the Fed would start lowering interest rates to get the economy moving again, which means that the excuse me the interest rates on treasuries and bonds will start dropping again, and so they are buying the short-term ones like the 1 month, 6 months, etc. Because they're thinking, okay, I can get more money for these very soon if I buy them now, as opposed to buying those later ones. Basically, that is the gist of it. I don't know if I'm doing the best job explaining it, but it basically just means the market anticipates there being economic problems, which will force the Fed to lower interest rates. It doesn't automatically mean that'll happen, but it is a possibility. And the last thing I want to talk about, and possibly the most important for a lot of you, is money market funds. So, most of you, when you save your money, which you should do, don't get me wrong, you just sort of leave it in the bank. And there's nothing wrong with that because the bank does pay interest, but it pays infinitesimally tiny amounts of interest. The current bank that I have pays 1/20th of 1% interest on the money I have there. And keep in mind, that's per year, like 1/20th of 1% per year. So the amount they give me monthly is that divided by 12, whatever that amount is. It's like tiny, tiny, tiny amounts. And so money market funds are a good thing for, just regular people like you or me because they're a good place to park your money. They're not really volatile. It's not like putting it in the market where you might lose some. They are just places where, again, people gather up money from a bunch of different investors, and then they just buy a whole bunch of really low risk but also really short term instruments, mostly like government bonds and commercial paper. Which commercial paper, if you're unaware, that's basically just companies need money right now, so it's like a bond, but it's very, very short term. That is the gist of it. And money market funds, like the one I currently use right now, is like 5% interest, so it's significantly, significantly higher than than if I just left all my money in the bank. And again, these things, you don't really need to worry about them losing value. There is technically still some risk there, but it is absolutely, absolutely tiny because these things tend to be very, very well managed because they know if there is ever a time where they lose customers' money, everyone is going to leave and go to a different money market fund. So, like the people running these things are generally pretty competent. They know what they're doing. And granted, the interest rates for them do go up and down a little bit, whereas your bank, it's kind of like set in stone and they don't change it that often. But again, it's a great way to save because you put your money there and it grows and it usually will not only keep up with inflation, but it'll actually exceed inflation a little bit. And they're very liquid. It's not like mutual funds where you may have to wait a couple of days in order to get your money back and you have to pay fees and stuff. Money market funds really aren't like that. So if you are this is like the one genuine piece of advice I'm giving is that if you're looking for a place to just save your money, either short term or long term, MMFs are a great place to do it. And I'm not going to recommend specific ones because I don't feel qualified to do that. But if you go to financial companies, like again, I should say brokers might be a better term for it. Like again, Charles Schwab or Vanguard or T. Rowe Price or any of those guys, and you look around, then you can like get an account started. And I'm not going to recommend any of them specifically, but some are better than others, so just do your research. And that is about all the stuff I wanted to talk about today. Like again, this is just kind of a basic look at some of this stuff, but I figure both for your own personal financial health and just so you can understand what's going on when people talk about big economic changes and like the news and stuff, I figure this should help you learn at least a little bit about it. Maybe you can do more research your own. And I don't know, if you're like a kid who's studying for this stuff in school, then maybe this will help a little bit. But that's about all. If you have more questions, I guess let me know down below. Have a lovely day.